sometimes these stocks, if you're just looking at those channels sometimes and you're like, oh, it's at the top of this channel, some of these can go well above where you think they can, and on the flip side, they can go well below
Right. Oh yeah,
some of these
absolutely.
channels. So, like, how do you kind of handle that when things are already beyond their norm and then they get even more so?
That's something that was always, I think it's a struggle for most growth investors because, we're investing in these companies because we think they're disruptive and they have all this potential. So as it's going up, it's kind of confirming what your thoughts were, but at the same time, it's becoming susceptible to these drops. So you kind of put in this catch-22 situation. If I sell the stock because it's extended, I miss out on the upside, but then I can avoid the drops. So for myself, the way I've kind of gotten around it is there's really a couple of questions I ask myself when I see a stock getting extended is one, do I see a runway for much more? Is the stock acting well, or is this later? Is this showing like climactic top action, or even like the valuations getting very extreme based on, let's say, there's no fundamentals, like for example the quantum stocks and the rest.
Yeah.
But also for me, the only way that I was able to kind of have my cake and eat it too was through options. So I'm not a big options trader, but in this case here, like I like to keep it very simple. I think of buying a put as if buying insurance.
Mm-hmm.
And the good thing about the way a lot of these leading stocks act is it's always like the saying, stairs up and elevator down.
Right.
That lends itself very well to options because options you want to protect against a quick drop. That because you only want to be in options when you feel you're susceptible to a drop, because obviously like any insurance, it's expensive to have insurance for no reason.
Mm-hmm.
And so that's the way I've been able to kind of mitigate that. So for example, like I had Palantir, in Q4 last year, and I forget the price of sales that we finally got up to. If it was like 70 times price of sales, which is a crazy number. And I eventually sold it into strength. But on that breakout, especially after earnings, when you have a catalyst, you want to give it chance, time to really work. So if you see in November when we had that breakaway move, it was really only once it started getting up near $70+ that I start to kind of decide to kind of take the money and run. But along the way I mitigate that, if I feel there's really some extension, I'll buy some puts a little bit out of the money. That way the cost is not too expensive. But if we get a surprise drop like Monday, I can survive. One, it's not as painful. And two, it gives me time to kind of figure out what next steps are. Is what happened real? Is this just a short-term positioning? Is it a news event that's passing and we can go back the other way? So I've really, you have to look at the more concentrated you are, the more dangerous it is when the stocks get extended, because it's
Yeah.
all about the portfolio impact.
Right. And so let's kind of break this down a little bit, because again, this really does come to that protection side of things. A lot of people are so focused on offense and how can I
Yeah,
get more money out of this stock? They don't think about the drawdown side, and
right.
that can be devastating sometimes, where you're making all this money, but what good does it do you if you don't keep it? So you mentioned that you're using options, you're using puts. So are you just buying a straight put, or are you doing spread trades or anything like that?
I like to keep it. For me, it's more about the timing of when to put the options on, because again, you want
Okay.
to. It's kind of a straight put buying,
Hmm.
and I think it's important because I just had a client call where we were talking about this subject actually just this past weekend. So it was unfortunately good timing. I was just saying, like when you're on the trading desk, like when I was earlier in my career, a lot of desks focus on VAR, which is value at risk, which is a 1 day metric. Like what's a really 1 day bad event that can kind of come and hit you.
Hmm.
And that's something you need to think about, because if it's a multi-day type of process, you have time to work off your positions. Like if let's say, you think the trend is changing, you say, okay, I can start to eliminate this stock. It's in those dramatic 1 day moves where you don't have a lot of time for positioning that it's just so dangerous. So that's why I like to just buy puts when things are extended, because that's when you're at most risk for those very quick drops to come against you.
Right. And so, are you looking? You mentioned that a lot of times you're looking at slightly in the money. So, are you kind of going for like a 50 delta? Do you have kind of a rule of thumb in terms of that? And then also, what kind of time horizon are you giving
Mhm.
yourself? Because of course, if you're going with a weekly option, that might be appropriate if you just need short-term protection for an earnings
Mhm.
announcement. But if it's like, oh, this is extended and I could see this having to do a base that lasts 7 to 8 weeks, well, then you might need to get a little bit further out. So do you have any kind of set rules, or are you just kind of going by feel and your knowledge of where the premiums are in relation to your size.
So I think it's important. I primarily want to use this approach for a stock that I think has the capability of going for an extended advance, like a real typical IBD, like a leading type of stock. Mm-hmm. And so if you look back at a lot of some of the best advancers over time, they always have these very quick 5 to 15 days steep pullbacks that will take place. They can be 10 to 25% is like a normal type of scary pullback that will come up from time to time. So that's kind of how I structured myself. So I like to buy puts that are about 10% out of the money, so a little bit lower, so it makes it cheaper, mm-hmm. and about 2 to 3 weeks out, because it's really it's not about protecting every downside dollar. Like, we're in the market's risky. That's what we're there for. Like you mentioned, if you're always, we were talking before the call, if you're always hedged, there's no point in even being in the stock anymore at right. a certain point, right? But it's really about, okay, if I buy protection, let's say 10% out of the money, there's a couple of situations. If the stock kind of just consolidates calmly or comes down 5%, everything is fine at a small cost of insurance. But if there's a more dramatic pullback, like we saw on Monday, mm-hmm. that's really where like a lot of the value comes in, and you can think clearly, and then you can adapt to the situation.